Hello, everyone. We're going to continue working on Pro-Forma examples that we worked with in the previous video. So everybody should have this file open, and we're working with the Pro-Forma To-Do tab. If you haven't filled this out, please watch the previous video to help you create the Pro-Forma for the income statement and the balance sheet here. Also remember, throughout our process right now, you can always click on this Pro-Forma Solve tab to see the solved version of the files that we are working on. In the previous video, we have created a step one Pro-Forma statement for this company, and we saw that next year it will need to borrow $2,995, or if the numbers are in million, $2.9 million. The question is, how would it borrow it? It would borrow it in the form of short-term and a long-term debt, because both is short-term and long-term assets increased. Next step from here would really be to go to the bank, borrow the money, and create a balanced balance sheet where total assets will equal liabilities and shareholders' equity. On our Pro-Forma solved sheet, I'm going to zoom in a bit, you will see that I'm creating a balanced balance sheet. As an example, I'm deviating a bit from my maturity matching, and I'm raising all of the funds through short-term debt or notes payable. So this is a deviation for a more restrictive financial policy. Today, we're going to look at variations in various performance matrices. So we will be working with the same income statement, but we will look at variations of the balance sheets that apply to this income statement. Therefore, I do not have an income statement copied everywhere, but if you prefer to have it over each balance sheet, even though it's the same, you can place it there if it makes you more comfortable. The first variation we're going to work with is the capacity variation. But before we get started, I want you to click on this Pro-Forma tab and look at this Pro-Forma matrix. This might look somewhat familiar to you, and that's because if you click on My Financial Statements, we've really recreated this yourself as you've learned all of the steps here. However, one thing that's still missing in our My Financial Statements is this column, the performance matrix column. So far, we've only looked at how to create a very simple type of step one projection. And it matches up with what we have right here with very simple step one projection. However, today in class, we will look at these projection matrices. We will start with what happens if the firm wasn't operating at full capacity. And you can see that this capacity is related to the net fixed asset account. What does it mean? If a firm is operating at full capacity, it means it's using all of its equipment. If you're making shirts, all of the sewing machines are being used. So next year, if you need to make more shirts, you need to buy more sewing machines. If the firm is not operating at full capacity, it means a portion of its net fixed assets, of its property, plant, and equipment, of its sewing machines, in our example, is not being used. So let's say you have 100 sewing machines, but you're only using 80 of them to sew your shirts. So next year, when you're going to sell more shirts, you're going to be less likely to need to buy sewing machines because you have 20 of them sitting there idle. So when a firm is not operating at full capacity in the previous year, it suggests that next year it's going to be less likely to need an increase in net fixed asset account, because it might not need to be buying additional equipment, or the equipment purchases are going to be significantly less as compared to when a firm would have been using all of its equipment and operating at full capacity. So this will be the first variation performance matrix that we will examine. We will also look at what happens if firms decide to change their minimum cash balance, decide to either increase or decrease their inventory, and decide to give either more or less credit to their customers. But the rule of thumb is the same here. Any increases in asset accounts compared to your base case are going to need to be funded with some money. So the higher the asset account next year, the higher the projection of any asset account next year, the higher the probability that the firm will need external funds. So if all of these accounts, cash, inventories, accounts receivable, and net fixed asset increase, this means the firm is going to be a lot more likely to get external funds. Also, the opposite is true. If the net fixed asset account is not as large compared to your base case projection of 100% capacity usage. It means the firm will be less likely to need external financing and borrow. We will also look at some variations in the income statement as well, where your cost of goods sold become a certain percentage of sales, but then that percentage of sales changes as your costs go up. For example, if firms are experiencing higher tariffs, their costs will become a higher proportion of their sales, their net income will become lower, their retained earnings or internally generated funds will become lower, and less will be reinvested back into the business. So let's get started with some of these performance matrix variation to our pro forma statements. This was just a summary of it. First, we are starting with capacity. We're going to assume that in the previous year, right here in 2020, in the previous year, the firm was using 80% capacity. Capacity deals with your equipment usage. So we will be looking at this account of property, plant, and equipment and net fixed assets, which holds your equipment. This means that out of $375,000, the firm was only using 80% of that. So specifically, the firm was only using $300,000 of equipment in the previous year. Next year, it's going to need to meet the sales growth of 20%. So to meet that sales growth of 20%, it's going to need to increase the net fixed asset or property, plant, and equipment account to $360,000, from $375,000 to $360,000. What does that tell you? That tells you that there's a decline in the net fixed asset account. This tells you this firm is selling equipment, selling sewing machines. This can happen, but oftentimes it's not the case, and oftentimes you'll be told that firms are not planning to sell redundant equipment. In that case, if it looks like your firm is selling, you can fix that by saying that next year is going to still keep the same amount in their net fixed assets. I'm going to address it by using an if statement. So I'm going to say, if next year my projection is below what I currently have, I'm going to keep what I currently have. Otherwise, I'm going to go ahead and buy what I need to buy in equipment. So I'm going to throw this in here. All right, we're done. So now we're at 375. I've started with a net fixed asset account because the first performance variation deals with capacity. The other accounts on the balance sheet will stay similar to our very basic or base level pro forma statement. Let's go ahead and build them out. From the previous year, my cash is going to grow by 20%. Again, if you want to copy the formulas, you need to make sure that your 20% growth rate is locked in. And that will allow you to grow your accounts receivable, to grow your inventory. Then we want to sum up our total current assets and sum up our total assets. So we see that from 514,000, next year, our total assets will need to be 541,800 in order to satisfy 20% growth, given that in the previous year, in 2020, the firm was operating at 80% capacity. You can see that this is much smaller growth in total assets compared to the base case, where the firm was operating previously in 2020 at 100% capacity, because the next year you need to buy more sewing machines, more equipment. If it wasn't using all of their sewing machines, you don't need to buy new equipment. As a matter of fact, in this case, we could have even sold some redundant sewing machines. Moving on, accounts receivable and accounts payable will both grow with sales. So my accounts payable will be growing at 20% with sales. Of course, my external accounts are going to remain the same as last year, unchanged, because this is my step one pro forma statement. I want to understand if I need external funds in the first place, if I need to go to the bank and borrow money. First subsummary, total current liabilities. Second subsummary, total leverage, current liabilities plus long-term debt. Next, it's important to create the proper retained earnings. Retained earnings are going to be my previous year's retained earnings plus what's coming over from my balance sheet, my internally generated funds. And the next sub-summary is my common stock plus retained earnings for total shareholders' equity. Finally, total liabilities plus total shareholders' equity gives me my total final. And you can see that my total assets at 541,800 are below my liabilities and shareholders' equity as 613,806 by $72,000 or 72,000 million. So you don't need external funds. You have extra money, extra $72,000. What can a firm do with that? You can take a look at our class materials, but I've given you an example of a step 2 pro forma, which suggests where I'm balancing out my balance sheet, and it shows you some of the options that the firm has, such as increasing liquidity or repaying debt and repurchasing some equity. This was our first performance variation dealing with capacity. As the asset account of property, plant, and equipment, net fixed assets, grew by less or remained unchanged specifically, our need for external funds declined. Because if asset accounts are growing by more than in the base case, then we will have a greater need for external funds. If asset accounts are growing by less right here as compared to the base case, we'll have less of a need for external funds. Next, you're going to look at additional variations. You're going to look at a higher minimum cash balance. Right now it's 23,000. Next year, the firm wants to have 40,000. I'm just going to briefly show you where to find some reassurance after you've completed the assignment. In this pro forma solved statement, you will see a balance sheet pro forma with the additional cash. You can see that our external funds needs are greater because the asset account is increasing by more than in our base case. You're also going to look at changes to accounts receivable, accounts payable, inventory, and several changes altogether. Finally, you'll consider a change to the income statement as that will then become reflected on the balance sheet through the retained earnings channel. All of the solutions are provided right here. But the main lesson to draw from looking at performance matrix is that anytime that you have additional increases in asset accounts, they need to be financed with external funds. The firm will need to go and borrow more. Anytime that you have declines or decreases in your asset balance sheet accounts, whether it's cash, inventories, accounts receivable, or net fixed assets, the firm will have less of a need for external funds, and it might not need to go borrow money. It might even have some extra money, like in this case, that it can then redistribute within the company. That is all for this video.